there. All right. Again, tonight we have Saul Doherty, one of my very dearest friends. So thank you, Saul, for coming. I appreciate it. So those of you in the room, if you have a question, then write them on these because the people on Zoom can't hear you. And then anybody on Zoom, if you have a question, I have Michael monitoring any questions that might come in. If we don't answer your question, it's because we probably feel like we answered it during the presentation, or maybe we need to get back to you. We might be running out of time. So I encourage questions, certainly. We will have a evaluation to be sent out to everyone as well. So we encourage you to respond to those once you get those. That'll probably be from Hannah. And by the way, thank you, Hannah and Michael, for your support tonight. We can't do this without you. So thank you very much. Okay, let's move on here. So those of you new to me, I do have a radio show, Kelly's Bull Market News. It plays on Saturday mornings on KNX 1070. You can also listen to any of my radio shows on my website. If you go to CaliforniaWealthAdvisors.com, there's a radio tab there, and you can click on, I have 3.5 years of radio shows now, and they're all have a little bit of title about what the show mostly talks about. So I encourage everybody to go listen to those if you're new to me, or if you want to listen to old shows. I also wrote a book, of course, The Great Retirement Mystery, How to Avoid the 6 Biggest Blunders. The biggest blunders are for anyone. What are the biggest blunders without giving my book away too much? Well, one of them, I was talking to Saul earlier, if you're listening to your brother's best friend's wife, do they really know about financial planning? Do they really know what's important to you and what you need in your particular financial house? So probably not. That's why we come to professionals like us at California Wealth Advisors, and we help you. So get my book. It's a great book, easy read, I think. Okay, let's talk about investing before we jump into Saul and Cottonwood real estate apartment program. So there's some key components to investing. One of them is to have a plan, and let's have a plan that's specifically created for you, because everybody's different with what they need, when they need it, what they need, how much they need, how many assets they have, where all the assets are. That's what I do. That's what we do here at California Wealth Advisors. We're going to look at all of your assets and come up with a plan that's specific to you based on your needs and your goals and your time frame. So that makes us very unusual to other advisory firms out there. A lot of them, and not that I don't want to poo-poo anybody, but they put you in portfolio A, B, or C, and that is not necessarily best for you. So let's make sure we have a specific plan created just for you. One of the ways we do that, the main way we do that, is through diversification, because you've got to have a plan, you've got to have diversification, and I'm starting to add, you need to have professional wealth management on your side as well. So having diversification, I think, is absolutely key for everyone as well. So there's the markets, the alternatives, and there's safe money. So this is my master proprietary process. I do have this in my book. I mention this all the time on my radio show. So here's a visual of it for those of you that have listened to me on the radio show and you didn't know what it looked like. Here's what it looks like. So M is the market. That's the red there. That's red for a reason. Markets are going to go up and down. So nothing wrong with that, but be aware of what you have. So M is the market, A is alternatives. So that's what Saul's going to talk about tonight here in real estate programs. So I love the alternative space, particularly the real estate space. There's also private placements, oil and gas programs for write-offs and different things like that as well. But again, we base this on you. We base this on what you need. And then S is safe. So that's when you say, hey, Kelly, I just really don't want to lose any money. I don't want to take any risk. Well, we can do insured products for you backed by insurance companies. So when we do all 3 of these, and not everybody does 33%, for instance, in each one of these, again, we're going to tailor make it for you. We're going to make sure what you need is being satisfied, and we're going to help you get there. So the master proprietary process is a great way, I think, to diversify portfolios and not just have you in portfolio A, B, or C. Really make it specialized to you. My private client process, I'm going to go over this in a minute. I'm going to bring this over so I can draw on this. Let's see, is that good? You guys see that? We got the sun shining in here too. Hopefully you all can see this. So I'm going to stop share so I can do this. So this is a visual of my private client process. So I position myself with my clients as the financial director. So the financial director, I believe, is what people need in their financial portfolios, because again, you don't want to listen to your best friend's brother's wife or whoever your neighbor, your coworker. They may not know what's appropriate for you. So if I position myself here as your financial director, there's certainly more to your financial house than just your investment dollars, which is here, which I'll talk about in a minute. So your financial dollars are really important. But we also want to look at risk. What kind of risk do you have in your overall financial house? And what am I talking about here? Well, I'm talking about insurance, perhaps. Do you have long-term care? Do you have life insurance? Do you have umbrella policies? Oops, umbrella policies. Let's make sure your assets are protected. Let's make sure any emergencies that might come or catastrophic things that might happen in your life are covered. We look at titling too. We look at how your assets are titled. That's a risk. If your assets are not titled correctly, you can be sued for your assets. I don't want that to happen to people either. We also look at taxes. What kind of taxes are you paying? If you're paying a lot in taxes, that to me is a risk to your overall portfolio, because I don't want Uncle Sam to get all your dollars, right? We want to protect those dollars as best we can. So there's a lot to having your risk managed. So risk management, I think, is huge in making sure your overall financial house is covered. Then we're going to look down here at estate planning. And a lot of people come to me and they have estate planning documents, but they're 10 years old, they're 20 years old. They had someone pass away, maybe their spouse passed away, maybe they're remarried, and those estate planning documents are not current. So let's make sure your estate planning documents are current. We want to avoid probate, right? We don't like don't like our heirs going through a probate. And any of you in the room or on the call here today that have gone through probate on assets you've inherited, maybe from your parents or something, it's not fun. It takes a lot of time. It can cost a lot as well. Again, we look at titling down here. We make sure your assets are titled correctly. And again, making sure your estate planning documents are in order. Again, we're looking here at medical powers of attorney. We're looking at medical directives if something should happen to you physically. It's important to have these documents in line. I am not an estate planning attorney, but I refer to a lot of estate planning attorneys that I work with to get these documents in place if you don't have an estate planning attorney that you work with. Then we look over here to the vault. So this is where all of your important documents go. So your estate planning documents go in the vault. Your insurance, your titles to your real estate all go in the vault. This is many of my clients travel. So I had a client and she went to Spain last year and she wasn't a client yet, but she got pickpocketed. Took her 2 weeks to get out of Spain because she didn't have her passport and they wouldn't let her out of the country. So we put passports in the vault as well. We do driver's license, anything that's important we put here. So your heirs, your beneficiaries will know where to go if something should happen to you. We've got it all there. You have access to all of this as well. So the vault tends to be a really great place to look at your important documents that you have. Okay, and then of course your investment dollars, very important. That's part of the mass proprietary process we work with. But I don't care if you have $1 million or $100 million here. If you're not taking care of all of these things and you could be sued for all of these things, let's not have that happen. Let's actually make sure you've got protection in your overall financial house. So I do charge a fee for all of these different things if you want me to work on that for you. But I think it's important as a financial director to look at all these different areas of your investment life. So anyway, I wanted to go over that briefly for you. We can talk more about that if you guys have any questions on that. Okay, let me go back to share. Okay, I want to go to this one. Okay, good. Is that working good? Yeah, we're working. Look at that. We just are so good technology-wise. Okay, so there's my private client process for you. Okay, I want to bring up Saul, and Saul Doherty serves as a Senior Vice President for Capital Markets Southwest, the distribution arm for Cottonwood Communities. Mr. Doherty brings 25 years of marketing and business development experience in the financial service industry, as well as 16 years experience in the real estate industry. Saul lives in San Diego with his wife, Allison, and 3 children. And I will have a little comment here that Saul is very good at doing Christmas photos with his family. They all dressed up, and maybe he'll talk about it. They dress up in the 9s. They're just amazing, beautiful photos. You have to mention a few that you've done. So really fun. So anyway, Saul, thank you for coming. We appreciate it. And I'm going to hand it off to Saul.
Thank you. Next time, maybe I'll have to bring one of my cards. I think the last one I did was was it Tiger King? We're all set up as a Tiger King on that. That was a fun one. And if you haven't seen the Tiger King, don't watch that. The card's better. But thanks everybody for taking some time to hear what we have to talk about. As Kelly mentioned, my company's name is Cottonwood. My name is Saul Doherty. And we specialize in real estate. As Kelly mentioned, I think one important thing is who you listen to about real estate, about investments, or that type of stuff makes a difference. And, before we get started, we always say there's a word from our attorneys that basically says everything has risk to it, right? And we need to be aware of that stuff. What I'm telling you today is not a solicitation to buy something particularly, but meant to be educational about what Cottonwood does and about what real estate is. And so, if you have questions about any type of real estate or things that we go through today, please put that forward for us. We're happy to answer that. What you're looking at right now is a little history of Cottonwood, right? We opened our doors in 2004. So we've got about 20-year track record right now of providing growth and income to the investors. We specialize in one thing, and that is apartments. We call that multifamily, and that's all we've ever done. What is unique about Cottonwood is that we're vertically integrated. So that means we own the property management company, we own development companies, we have a cable and internet company where we have to actually put fiber optics into the buildings. And then we buy the cable and the internet from our local provider and sell it to our own tenants faster and cheaper than they can get it in the open market, right? We have a thing called a resident indemnity company, where if you live in one of our apartments, you have to get renter's insurance because, with each apartment comes a kitchen and the risk of causing a fire. Should you burn down one of our units, we need to make sure that you can pay the $50,000 to $100,000 deductible that the property and casualty policies have. And the reality is that we offer private insurance so that if you don't want to insure your stuff from State Farm for probably nowadays it's 40 or 50 bucks a month, where it used to be 20, you can spend $9 a month and just indemnify yourself from any damages to the building. It's not so unique that we own different businesses around multifamily. What is unique is that my fund owns all those businesses. So all the revenues from all the operating businesses are actually shared with our investors. And we did that process called internalizing back in 2011. And that entity, the operating businesses, have been inside of our funds ever since then. It makes us, we took shares back then. My four original principals and executive team actually currently own 10% of our common equity. It's the largest single shareholders there. But what it does is it aligns us with our investors. So as we make decisions for real estate, as we make decisions to make money, we own the same shares you would if you buy into Cottonwood. And while we bought them a while ago, it's the same performance. It's the same distribution rates. It's the same everything on there. And so I like to tell people we make very greedy decisions. They're just greedy for all of us. And my CEO will tell you, we do things long-term greedy, where if we keep doing it right and we make money for everybody, everybody will want to continue to do business with us. And we hold that philosophy very, very true to our hearts. The reality is we don't take it lightly when people invest with us. This is my executive team. This slide is actually a year dated now. So, Dan and these guys, we just celebrating our 20-year anniversary of the company being open on the 15th of August next month. But everybody's been here for a while. Like, we haven't added an executive member in a decade. Nobody's left. Things aren't broken, right? And this is a group that's really worked together great for a long time and has come over with tons of experience on their own from previous lives, right? And so for us, I believe we have put together the dream team of who's dealing with apartments. And our specific model is these Class A, newer, nicer apartments that you see around the US, right? So this is what the portfolio looks like today. It says 2.3 billion in assets. We're actually at 2.4. We just crossed over the other day. We've got about 40 different investments inside the fund, about 11,000 units across the operating, the development, and the ones we finance for being developments, which I'll talk about in a second here. Average rent in one of our apartments is $1,700. If you're here in California, some people are on Zoom, you'll know that's not mostly here in California, right? We are focused, and as you can see in kind of the upper right-hand corner there, in the growth sectors of the US. So we're specifically looking for where you're seeing job and population growth, right? For us to be investing. And the $1,700 rent is up. I mean, a couple of years ago, we were down at $1,400. You've seen that rent growth there, which is integral to how we're actually growing value for our investors and what we're seeing in there. 94.6% occupancy. Some people would tell me, oh my gosh, you guys don't have 100%. No, of course not. We want 94 to 96% so that we have the ability to have people move out, people move in, and press those rents, right? One of the best things about apartments is that we get to renew our rents basically every year, right? Most people sign a 1-year lease. And so every year we're able to reevaluate whether or not that rent makes sense or if we can get more for it. And typically you're striving for 2.5 to 3% rent growth. Over the past history, especially over the last several years, we've seen astronomically higher parts than that. You know, in 21 and 22, especially after COVID, we were seeing 20% rent growth, 15% rent growth. You know, that's tailored back now to more reasonable numbers. And in truth, I'll talk about it in a minute here about how supply has been going and things like that and how that affects rents with there. But that's really what drives revenue. It drives the net operating income. If you grow rents, you're growing your revenues. If you mitigate expenses, it creates your net operating income. And that is really what we use to evaluate real estate, commercial real estate, stuff that's not your personal residence, right? We're going to be able to create those. And so for us, 94.6% occupancy means that our rents are spot on, right? We've got enough vacancies in there to be able to move those rents. And we've got the numbers right so that we're not down below that. My leverage inside the portfolio is 55.3%. That's up a little bit from where we were before. I'll talk about it, but we had a price come down a little bit due to mitigating factors with interest rates. So we see that there. We'll probably see that go back down again as we do some stuff to bring down the leverage on that side. But leverage can be one of your best friends, and it can also be something works against you, depending upon how markets are running. So if you're seeing good things and we're seeing values come up, it makes those values kind of exponentially go up. If you're seeing, you know, things that might cause it to go down, it can be a deterrent on you. And finding that right spot and leverage is really key. We would never go above 65% loan to value, right? We like to see it in the 50s, 55 kind of less. You know, historically, we've been somewhere around 50 or lower on there. So very comfortable with where we sit today. I mentioned it earlier, but if you look in the upper right-hand corner, these are the markets that we target and are in, right? You can see we're a little heavier in Salt Lake City. It's been one of the fastest growing economies in the US. Utah has actually been fantastically growing, really strong for businesses, has a great population moving into there. We happen to be headquartered out of there, so I'm a little bit biased, but it does really well. And if you look at those cities and states, you kind of know that's where you're seeing job and population growth. That's where you're seeing people really move to, right? And if you go below that, you'll look at the other way we diversify besides geographically, which is how we invest in apartments. So operationally, meaning things that are rented out, people that are living there, right? 72% of our portfolio is that. That means there's bodies in there paying rent and it's working forward like that. The other thing we do is ground up development. We'll actually build apartments from the ground up. About 18% of our portfolio is ground up development. That means we're building it. And you get a lot better returns if you're doing development right, but it has a different element of risk to it. So we want to mitigate that and not have it be too much of our portfolio. The other thing we do, we call real estate related investments. That's where we're actually lending money to other developers to build apartments. And right now, over the last 18 months, that's been a really great spot for us to look for opportunity. Together between development and real estate related investments, we like to see anywhere from 25 to 35% of the portfolio. Probably would never go more than 35%. It's been difficult just to get to 25% really over the past years. Today, you can see here, we're a little bit above that at 28. That's great. Part of that is because on the development side, we've actually got 2 assets that are totally built. So there's a lot of value in there, right? As you start a development deal, there's not as much value because you got dirt and money and pieces. You put it together, you start building it, and you got a structure that's worth more value than that. And once you get it leased up, it's got more value to it. So having 2 assets that are built and being leased up has a lot of value on that side of it. Once they hit 90% leased up, it moves over into the stabilized portion, and you'd see that shift over. So those numbers are always moving around, right? And the balance of that is what you hire us for. Is part of what you looked and say, what makes the most sense to do today to invest? And as I just mentioned, you know, we were putting a lot of money in the real estate related investment side. That's because, as everybody's probably aware, we saw interest rates spike in 2022. We saw the Fed raise rates from 0 to 5% in the shortest period of time we've ever seen interest rates move, right? Actually, ever in the history of the Fed, period. And it caused banks to have some issues, right? We all heard about Silicon Valley Bank, maybe First Republic, that had some exposure from that type of stuff. Well, those are regional banks, and those do most of the lending to developers, right? And so when those exposures happened and they were having liquidity issues and interest rates were rising and cap rates were rising with that, they just said, we're not going to do as much risk of lending to developers. And you saw them where they normally lent 65% of the construction cost to maybe 75% of the construction cost to a developer, say, we'll do 40, maybe 50, if we're even willing to do that. And so it created opportunities for us to step in and say, well, we'll lend the money the gap between that 50% to maybe 65%, but we want a 14, 16% interest rate on that. And so those are just creating opportunities for us to be able to do it. Once again, mitigating where that is because it has a different risk to it, right? You don't want too much of that exposure on there. And one of the benefits for us in being able to do that is because we're a developer, if something were to happen, if the person was to default on that loan, we can actually step in and take over the project. I'm happy to say that's only happened once in our career of lending to investors, or to developers, I should say. In Sacramento, last year, actually, we took over an asset, moved from that real estate related side over there. It was right after the developer had kind of finished building it, and the banks were having their crunch and interest rates were rising. And they said, we want you to start reserving capital, putting money aside to fix the financing that's going up on it. And the developer was out of money. And unfortunately for them, we had to exercise our buy, sell, and take it over. I think for us in the long term, it's going to wind up being a value add to the company, but it shifted around how we did it. And it took money on our fund side to put in there and right size that. It took our ability to step in and do the lease up on it. And eventually we're going to wind up selling that property, I think, is what's going to be a really nice profit and seeing benefits out of that. But you have to have the experience that we've had over the last 20 years of doing all aspects of that to be able to step in and take care of that. And I think we've done a great job with that type of stuff. And I think it's a lot of the reason why people do business with us, because we can deal with that. So what I'm going to talk to you about now is some of the things we looked at, but is why we invest in certain areas and what we're doing. So I mentioned it before, we're looking for the growth sectors of the US. This slide talks about what counties are growing in the US. What percent of population and job growth are we seeing? So dark blue looks like we have people moving in there. And if you look at where these yellow dots are, this isn't the greatest slide in the world. You can see we kind of did the Wayne Gretzky of go where the puck is going, right? This is where we were seeing, through 21 to 24, migrations of people moving to. And that's where our assets were, right? That's where we were building things and buying things and financing things. We also look at where are you seeing the national GDP grow? I mentioned Salt Lake City. You can see Utah is a really heavy, deep blue here. That's because we're having they're creating more GDP growth out of that market and that area, and we're seeing on other sides of the country. Consequently, that's where we have heavy exposure of growth. That's where you're seeing us lean on where we're having that development and assets be there. And so what we do is just track across the US, and we will shift it from time to time. Like, I don't think there's anything wrong with Houston, but we're seeing better opportunities elsewhere. And so we divested out of some of our assets there, still have a little bit of exposure in there, but we moved it to other markets that are just doing much better. And so you'll see us do that type of moving around for assets. I mentioned earlier that we focus on Class A apartments. So that means the newer, nicer apartment. Something where you're seeing maybe built in the last 5 years to 10 years. Its location is more of the downtown of an area where you're seeing growth. It might not even be in the right downtown, but like on the edge of that right downtown where it's a little bit more affordable on that side of it. The reason for that is multiple reasons. One, it costs less to operate something that's newer. It attracts a higher rent. And so that's incrementally more profitable. But most importantly, our tenant base is a higher credit tenant, meaning they tend to have a better job. So I look at these two on my orange colored jobs as a little bit higher value job, right? It's got more technical, it's more corporate focused. When you look at the blue ones, they're skilled, they're trained. They're actually the workforce labor that we know and love, and is a majority of Americans, right? The hard part is the orange jobs tend to take a little bit more higher education. They tend to be more resilient to economic hardships. And those people's jobs and salaries tend to keep up with inflation better. So as we check unemployment rates over time, the blue dotted line being the skilled trade, and the kind of brown bars, if you see there, will be the technical corporate focused ones, right? The line is tracking unemployment rates. So as you can see in 2000, when dot-com bubble popped, we saw the skilled traded labor find unemployment rates much faster, much longer, much deeper than we did in the technical corporate focus ones. In 2008, it was exasperated. It was a huge change in what we're seeing on that stuff. And that dip and the difference between there was even more astronomical. Even during 2020, which I'm calling not really a financial crisis, but it was kind of simulated one that happened much faster. And we all know during COVID, right? You couldn't go out, people with workforce labor and stuff like that, they just tended to have to stay home. You saw that unemployment rate go much higher. We collected 97.8% of our rents during COVID. That's a phenomenal number. 97.8%. Normally it's 99. So down very little bit. Different pockets were a little different. Not everyone was the same. But I talk to people all the time that own real estate and say during COVID, I had 2 or 3 of my tenants in my fourplex that didn't want to pay rent or couldn't pay rent. And it was devastating to me. Well, it's part of the reason why you invest in our assets, because I already want 5% vacancy. So I'm fine if some people can't do it. But the quality of the asset attracted a higher credit tenant. They flipped on a laptop and went to work. They paid their rents even through that period because they want to buy a house someday. And yes, you didn't have to pay rents during COVID if you didn't want to, but we were going to come after you when that was over. And they knew that, right? So the quality of a Class A asset attracts all those things different. The other thing that I'll tell you is a Class A asset always has a buyer. When it's a newer, nicer, bigger property, there's always an institutional group that wants to buy it. And case in point, over the last 18 months, we were able to sell 2 assets to make sure we had liquidity for our investors that wanted to redeem, and also to reposition that money into the real estate related investments that we just talked about that had better opportunities to it. And so as we put this focus on there, it's very important to us that our drive is always to the Class A. I'm not saying we would never buy a Class B, because we have. And we fix it up a little bit and sell the dream to somebody else because it makes that sense for them. And we always drive back to Class A. Because what you see is real estate goes in cycles, right? Kind of builds. They run in about 8 to 12 year cycles, and then they shift again. In fact, we just went through the biggest shift in real estate that we've seen in 14 years. 2008 was probably the last cycle of real estate. Because once again, I said, I'm not counting 2020 since it was so quick, right? But as you can see on here, as we track housing and supply, right? From 1968 to 2008, on average, the country built about 1.5 to 1.6 million new homes per year. Gray represents single family, orange on here represents multifamily. As 08 hit and the financial crisis happened, banks once again stopped lending to developers. People's rents were coming down, right? Because they couldn't get in that side of it. And we saw that the supply in the US dropped off enormously. And over from 2008 to 2023, it's just over a million homes we provided. Almost 500,000 less per year. For what is that? 15 years, right? Do the math on how much shortage we are of what we have. And in 2022, right as that started to get back almost to the median, we had the interest rates rise. The Fed raised rates. And as we just discussed, we saw banks stop lending to developers. And consequently, the new supply for homes and apartments has fallen off immensely. Nobody can feel it. Everybody I talked to I see cranes, I see buildings, I see things going up. And you're right. Most of those are starting to get finished. And by the way, it's not gone. It's just dropped off about 40% per year since 2022. So 70 to 80% down on new startups, specifically for this sector to it, right? That's showing there. It takes me 2 years to build an asset from the ground to where it's ready to have people leased into it. So anything that was started in 2022 is being finished in 2024. And then it takes 9 months to a year to lease that up to that 90% occupancy and above that we're always looking for. So you're really going to see the rearing and the effects of this lack of supply end of this year, beginning of next year, all the way through to 2026. Right. And what's interesting for us as we look at this, sorry, I thought the next slide was showing the same point to it. That's a huge drop off. That's kind of economics 101. When you have high demand and low supply, what happens? Right? Prices go up, rents go up. I would also offer to you guys, how many people in here refinanced a house in the last 10 years or even the last 5 years, right? I mean, they're all sub 3% mortgages unless you did it really recently. And the truth is for everybody that bought their first time home before 2022, they wound up that 3% or lower mortgage. It might be their last home that they buy because that debt is now almost a financial instrument to them. You're not getting a 2.75% mortgage ever again. They may come down a little bit, but I doubt in my lifetime we're going to see that side of it. And so people that have that mortgage at 3% or sub 3% are just not selling those homes. I mean, not never, right? There's people that get married, divorced, there's jobs that force some of that stuff. But for the most part, people are not selling those and buying homes because the values went up, the taxes would go up, their interest rate would go up, and it makes it much harder to get into a single family home. In fact, if you do the math right now, you can see that an average rent for an apartment is about $1,800 across the US, specifically in the markets we're looking at. Okay. To buy a home, it's about $3,200. That's almost a 45% increase to own the home in the payment that you would have. So if you're a 24 to 40-year-old savvy person moving into an area trying to get a job, do you say, do I buy a house here or do I rent something? It actually pushes them to renting my apartment, right? And that is going to drive on all that. You couple that with the idea that we might see some interest rates come down a little bit in the future. That'll help with apartments, but that's all driving to the value of what we bring to the table. And I bring you back to what is our model, right? It's operating, it's real estate related investments and ground up development. And so to give you an example of what we do, this is called the Mark at Highland Park. This is a property that we bought in 2017. It was built in 2015, so relatively brand new. We did no value add to this. We didn't, remodel anything. It already had a little retail space on the bottom, and we've just grown rents and it's done really well. It's high-end finishings. You're seeing granite countertops, custom cabinetry, stainless steel appliances, 9-foot ceilings. Kind of wood and planking, vinyl planking. Excuse me. Many of these have dog parks in them because we all know our four-legged creatures and children are so important to people. And one of the things we are doing is we'll go in and take these clubhouses that, most people don't really know about, right? You go into a nice apartment building. It's kind of this maybe 1,500 to 2,000 square foot area. It's got a couch and some great pool tables, and it's just nobody's in there. It's just dead. We turn them into what you guys might know as WeWork. We call them apartment co-work spaces, and it's basically office space. They've got Zoom closets that look like an old phone booth, but it's just a table where you can put a computer and do a Zoom meeting. They've got cubby holes where you can do work. They've got conference rooms where you can get together with people. And it's got 1,000 gigs of Wi-Fi running through it. So I don't care if you're gaming or working or doing whatever. It's a great space to get out of your 1-bedroom, 2-bedroom studio where your dog, cat, boyfriend, girlfriend, husband, wife, whatever it is driving you nuts. Right. And it gives you a different space to work. And that is some of the value add we do to those. That's not really remodeling. That's just putting Cottonwood's flair on things. And we think that's a really great way to get value in these. The truth is that if you know 3 people in your apartment building, you're 85% more likely to renew your lease. So we don't monetize that much. I mean, we do offer a little bit out there for if somebody comes in and says, hey, I'd like to look at an apartment, but let me think about it. Oh, would you like a free pass to our, apartment co-work space? But that's some of the stuff that we do on that side of it. As we look at development, this is an example of a property we built in Salt Lake City called Sugarmont Apartments. It's in Sugar House, which is an area of Salt Lake City. We're very creative on our names. But this is something we built from the ground up. This one actually has some 3-bedroom. You can kind of see them there in the picture on the lower left-hand side. Very rarely do we have 3-bedroom apartments. This was townhouses that was part of accommodating for what the city wanted to have. But this is an area called Sugar House District. It's probably the most sought after market of Salt Lake City and one of the fastest growing areas of that city and the state. And we think this is a flagship asset, right? This is beautiful. It's got great rents on it. Right next to it is Sugar House Park, which is forever wild, and this great park running in there. You can walk out to Whole Foods, bunch of restaurants, different things like that. And it's just a great asset. It's 96.2% occupied. It's now actually moved from our building side to our operating side. As we look at loans, this is a great example of one that we did not too long ago, $10 million at a 14.5% interest rate in Hollywood, Florida, right? It's a 3-year deal with 1 year option for us to extend or them to extend, excuse me. If they wanted to get out early, they still owe us a 1.4 multiple. So we're getting paid no matter what on this. The truth is there's some points in and out that'll get us to a 16 on this. So it's a great way for us to look at that. And, looking at something that's active, you look at what have you done in the past. I mentioned previously when we did this in 2019, we were getting 12% coupons, right? Now, this was a guy who actually sold that piece of real estate before, right as he got finished and got out of it a little early. So it was a 21-month duration. We did the same thing and took that money and moved it over to Reno, which is also a booming market. Did the same thing, but we put a prepayment penalty on it. When they tried to get out early, we got a 1.3 multiple. And what was really a 12% preferred return turned into a 21% return to the fund, just a shorter period of time. And then we had to redeploy that money, right? So these real estate related investments are nice. They're smaller chunks of money, so a little more hard to get into them. You got to have more of them. They can be shorter durations, right? They don't have quite the same tax benefits that we see on owning the real estate where we get to depreciate it. But we love this as a segment of it. And it's where we've really put focus on doing some investments over the last 18 months. We are right now looking at buying stabilized assets. It's turning out that development is becoming more expensive than it was previously. And it may cost more to build something than it does to go buy the replacement property. And so once again, we're shifting how we're doing that investment. We'll finish the developments we have going. They're actually great. And we have a lot of value in those that are doing really well. But we'll keep shifting that around as we look at it. And frankly, if you look at the history and what's happened with real estate, right? Looking at historical returns, the millennial generation, and what's going on, multifamily apartments has been one of the top performing asset classes, right? Industrial recently had a great run with it. Thank you, Amazon. Anybody order anything today to be here tomorrow? I've done it. My pocket's gone off twice, I think, since I've been talking. That's my family ordering on there. But industrial has done really well, right? They're a little bit longer term leases. So those don't quite have the same inflationary hedge that you see in multifamily. And multifamily's just done really well, right? And we talked about a lot of the reasons why I think that's going to happen again. In fact, if you look in 2022, right, and previously, multifamily has outperformed inflation by 6.8% annually. And during the hard part where we saw really high inflation, it exceeded it by 15.6%. And I talked to you guys earlier about how we had a moment where we're seeing 20% rent growth, 15% rent growth. Right? That was that inflation. We saw inflation coming in there for lots of different reasons. Mostly we pumped a bunch of money into the economy that everybody had to spend. And so that pushed that there. We couldn't raise rents for a period of years during COVID. So that grew, but it upkept and held with that. It's also what caused a really big boom in the real estate. And so as we look at those things going forward, we see what drove that. There's a millennial generation we've all talked about. No, there's Gen Z right behind them, right? That look like they have the same type of tendencies. The truth is the world's a different place. People don't get out of college and are married and start a career at the same company for 30 or 40 years. You're working for a company for 2-3 years, maybe 5, and then you're moving on to the next place. People don't have kids right away. People aren't getting married in their 20s. And all those things drive to that kind of turnkey lifestyle that apartments have really been giving you. In fact, I would argue that it's more important for a lot of people to get a selfie in Malaysia they've never been to than it is to own a home in their younger years. They want to be mobile. They want to be able to get around. And so that's really driven towards multifamily. If we look at where we are today, all right, and what are the Cottonwood cycles on programs? What have we seen as past performance from Cottonwood? What is Cottonwood's today distribution and pricing? I'll take you through that. So just to show you kind of past deals. These were funds where we raised money, we deployed the money and bought real estate, and then we created liquidity for the investors. So if you look on the far right-hand side, right, you'll see what I call the average investor internal rate of return. That means net of all fees, what did the investor get at the time we created liquidity? 11.7 is my lowest internal rate of return. That's a phenomenal number, right? 12.8, 12.3, and 17. The bottom one was a development deal. So that should have been a higher total return when we looked at that. The other ones were stabilized assets, and the top one was actually a blend of them. They're all different periods of time of when we started those funds, as you can see on there. But they've done really, really well. Today, we marry that all together in Cottonwood communities where we have all those aspects put together. It used to be that we did. We have a fund that has liquidity on a monthly basis. And our common equity, if you buy in every month, we offer new investors in and old investors out, right? We have a cap to protect the fund that says if more than 2% of everybody of the total fund value looks to liquidate, we have to prorate that so that it's not more than 2% in any one month. I'm super proud to say we have never hit that cap. We have always honored every redemption anybody has ever asked for from Cottonwood in the history of our company. That is huge. We've returned over $100 million of equity to investors that wanted to get it back over the last year. And we've always done that at their request. The other part to it is that we've always kept our distributions. We've always paid our distributions. We've never lowered a distribution. We've grown them in every one of our funds. We've never retracted that back. And when you look at real estate, you know, one of the biggest things you want to see is you want to create income streams for yourself. I don't care if you're using it for lifestyle or you're dividend reinvesting it to make it more of a growth vehicle. Tax advantage income is one of the biggest parts on that. And so we take that near and dear to our heart. We watch that. Where we are today and what's happened in the past here is right here. So my share price, this is a little hard to read, says it's 1270. Okay. These are the distribution rates on the left-hand side. 4.9 is what you're going to take a look at, right? Or actually 5.5 in the advisory side of it. That's what our distribution rate is as of today. What I'm going to bring you to is the lower right-hand corner over here, where you see our since inception, since December of 2018, what our average annualized return is a 9.5. That is a great number. That took us through a really big boom in real estate. And recently, it took us through the biggest correction in real estate that we've seen since World War II. In 2022, the Fed raised rates from 0 to 5%. It caused the cap rates to rise. My portfolio was structured at a 3.8% cap rate, meaning on average, the company that appraises my assets every single month and tells us what our price is said, today the cap rate is a 3.8. For those of you that don't know, a cap rate is the income coming off of the price that you paid for the piece of real estate. So the yield with no debt on the value of the real estate. And as cap rates rise, if you don't increase your revenues, the values go down. Okay. So every month they were pricing. And as the Fed raised rates from 0 to 5, the philosophy is, why would somebody buy a piece of real estate that's generating a 4% yield if I can go to the treasury and get a 5% yield? So the cap rate that we use to appraise those assets go up, and we had it go from 3.8 to 4.9. That's a 30% change. If we're 50% levered on average, that would have meant a 60% drop in the value. And we didn't see that, but you can see on here, we had almost 28% change in the last year. That means we grew our revenues, we grew our rents. We did the job to mitigate that external force that was changing those values. We never dropped our distribution. We never missed a distribution. We honored every single piece of liquidity that anybody could have asked for. And while it may feel weird to say it, we did a great job through that period. And where it sets us today is at the bottom of a new real estate cycle. And the opportunity has probably never been better to get into there. So at my peak price, I was $20.72. Right now I'm $12.70. Right. That is, and it's going to toggle around, I think, for the next couple of months, maybe pennies up or down. Right. I think it's going to be a little flat maybe for the next month or two. And then I'm going to start seeing some things really grow, is my expectation. And it's for everything I talked about earlier. Lack of supply, possibility of interest rates going down, right? The reason why people can't get into homes and the cost of buying a home that runs with that, and the demand that's going to go with it. Now, give or take a couple months on everything for me, because I don't know. And that's barring some major thing that we aren't aware of. But for the most part, all the indications show that we're at the bottom of a real estate market and growing. If you look at what my price is, this is kind of explains where I talked about. We started out at $10 a share. We grew it to $20.72. It right now is at this $12.70, but we never dropped that distribution rate. And as you can see, we've kind of plateaued out here on the price. I think we're going to start to see some growth on it. I think we got a little while to get into these. Once again, we only let investors in once a month at the end of each month. We let investors out once a month at the end of each month. So every month you kind of see these things marked on there. And I would argue to you that this is probably the best opportunity we've seen to get into Cottonwood, to get into apartments in a long time. I think the difficulty that a lot of people deal with when we're dealing with investments in general is, when do I buy? When do I get in? When is the all clear, right? And the truth is, if you go back for the last 25 years and you bought commercial real estate, so not your individual home, but any type of commercial index REIT or something like that, apartments very specifically, there is no 5-year window that you bought real estate and sold it that you lost money. So even if you bought at my peak, right, at the very moment of the very peak, I'm going to bet you in the next 5 years you're going to be positive numbers. It may not be what I had always intended, which I look for an 8 to 12% total return. You saw generating like a 5.5 right now in yield. I expect to see another 3 to 5 to 6% growth on top of that. But this is a longer term investment. So while I have liquidity, even right away, for the first year, it's 95% of the value of whatever the stock price is. If you look to liquidate, after 1 year, it's 100%. Right? We're looking to see, you want to be invested in this with the expectation of a 5-year plus hold. If you need it, if life changes, we can mitigate that and offer your money back to you. Right? But real estate is really something you're going to own for life, to be honest with you. This is a perpetual fund. I'm never liquidating this. You're going to choose if you want to rebalance, if you want a little more income than we're providing for you, or if you need your money back for whatever it is. And I will tell you, Kelly is amazing at when you come and say, I need money, about saying, where do we pull it for the most tax efficient way? Don't stare at this and say, what is that? If you look and said, I need money, you don't ask, what is Chevron's distribution rate on a stock? You just say, Kelly, I need money, give it to me. And she will help you design where that is. The benefits, though, are that the yields that we've put out have been tax sheltered. Because it's real estate, we get to depreciate the value of the real estate over 27.5 years, specifically to apartments. Some things are 39 years, right? That creates a shelter so that it looks like the income you're getting is a return of your principal. You don't pay tax on it. It just lowers your cost basis. If you liquidate, you'll pick that up as a long-term capital gain as long as you held it over 1 year. And so we talk about real estate having a great sector, one, because this is private real estate and it's not correlated to the stock market. It has its own ups and downs, but it's not tied to that. Two, because the incomes that we generate on it typically are tax preferred, right? And you're getting that in a much, capital gains is still better than ordinary income tax, even in California, right? You're looking at a better structure for that. So it's a great way to generate these. I don't care if you're dividend reinvesting and just not having to pay tax on that, or you're using that money for income, or however it makes sense. And these are good for qualified accounts. So if your money's in an IRA or a retirement account on there, that's fine. We accept that money, and those have their own tax treatments to it. Kind of wraps that into a different wrapper in there. I think I've said this already, but the greatest part about Cottonwood and the structure we have is that we're pricing monthly, so it's very transparent, right? You're going to be able to see. We offer liquidity monthly to our investors. You know, we've been doing this for 20 years in a very successful spot. And what I see going forward is a huge opportunity for being able to get in the real estate at the bottom of the cycle, right? I will tell you, after all that, if you're still feeling nervous, I'll be amazed. But we do have other opportunities. Talk to Kelly. We offer preferred stock too. Preferred stocks are a way that you can get an income stream that's higher than what I showed you on there, but you give up some upside, right? You're just getting that. We have a convertible one where you're getting an 8% yield, and then it becomes convertible after 2 years to the common stock. Either you could choose that or we could force you to do that. Those are available to accredited investors. We have another one that's a 6%. Goes for 5 years. It has an escalator in the last 2 years up to 6.25% and 6.5%. But if those are things you're thinking about, sit down with Kelly. Say, I like real estate. I like Cottonwood. I love salt. What makes the most sense for me? And, I thank you guys for listening to me. If you've invested with us, thank you so much for your trust. We don't take that lightly. We will continue to shepherd that money and do well with it. And so thank you.
All right, thank you, Saul. Stay here, and we can be in the picture. All right, a few things I was taking notes of why I like Cottonwood, and Saul, of course, is my good friend here. But I love that they have liquidity offered monthly. A lot of the real estate programs are 5-year programs, and you need to stay in them. You really can't get out of them. I love Saul and I love Cottonwood. Eric Marlin, also one of the CEOs, is a good friend of mine as well. They're very smart to offer that liquidity because it makes them a little bit different than some of the other REITs that are out there. I love that the yield is tax advantage. That's wonderful too, especially for outside of retirement accounts. A lot of my clients into retirement are looking for that tax advantage income, so they don't have to pay taxes on everything. I love that there's a shortage of housing. They're certainly taking advantage of that. Not many startups over the last couple of years. The lack of supply allows for growth over time in the price per share that they offer. So I think that's wonderful. It is a long-term investment. I don't want you going in this month and out of it next month. It's not designed for that. It's designed to be probably a 2 to 5 to 10 year type of investment. That's where you're going to see value. And I bring this comparison up a lot of times with people that are in any kind of real estate programs, Cotton being one of them, that the prices come down a little bit. And I liken it to IBM. IBM's a big, huge company, been around a long time, great, wonderful company. If you buy IBM at $100 a share, and for some reason it goes to $80 a share, do you sell it? Well, no, you're gonna keep it because it's a good, great company. It's gonna come back to 100 and go up from there. Say, buy more when it's 80. Same thing with Cottonwood here. It's, if the price is down a little bit and real estate still looks good, it's still got great real estate. You're seeing pictures there of all the real estate they have, Class A apartments. Wonderful, great time to buy more. Dollar cost averaging is the same type of scenario there with my IBM example. And I love that Cottonwood is an alternative to the stock market. So you're not necessarily in the stock market with everything that you own, or in my view, as I mentioned my mass proprietary process earlier, you really shouldn't be, because you need to have diversification in your portfolio. So Cottonwood is a definite way I do that. So thank you, Saul.
You're welcome.
Appreciate you coming. Let me finish up my
Yep.
slides here.
Any questions?
Okay, if you have questions, submit those. We'll get to those later. For the interest of time, I want to make sure everybody can go on to other events, maybe look at the Olympics or something tonight. So I do have more seminars coming up. Check my website, California Wealth Advisors, to any ones that are coming up. I do have some oil and gas ones I'm going to bring to the table. I have other different kinds of investments. We just had a money manager that we did one with. So check the website for any upcoming events. So again, if you're new to me, I do like my first meeting to be in person because I want to get to know you. I want you to get to know me too. I can do Zoom meetings and phone calls as well. So I encourage you to do that. So thank you everyone for joining us tonight. Really appreciate it. We will be sending you an evaluation form, because if the lighting was good, the sound was good, you love Saul, we want to hear any kind of comments that you might have as well. So again, thank you, everybody. Appreciate it. Nice to see you all. Thank you, everybody on Zoom. Have a good night. Okay. Good job, Saul. Yay.
Yeah.